Hello, Uncle Jim here. Today I want to share with you one of the greatest ways to make passive income, and that's selling options. In particular, I want to talk about how to mitigate your risk, how to keep it safe. I find a lot of new traders jump in with both feet and get themselves in trouble. I'm also going to share with you some trades and explain a little bit more about my planning worksheet and how it works. So stay tuned. I think you're going to enjoy what I have for you today. Okay, now when I start my videos, I typically like to give an idea of what I think is going on with the market. I do think May we're going to trend sideways. I would be surprised if we get any major bounces. We may test new lows. Historically, May's a bad month for the market, and I think that's probably going to happen for most of the summer. I do think we may get some nice bounces later in the year, maybe late summer, early fall. I also think that the Fed is done raising rates. They're kind of suggesting that they won't raise again in June. I wouldn't be surprised if they don't raise again in June or July, and not even in the fall. They may actually just hold steady and then may start lowering rates. I wouldn't be surprised that late fall, early winter, that they start lowering rates and bringing the rates down. And part of the reason I wanted to share that, at least that's my opinion, is because so many people are potentially liquidating assets and putting more cash into treasuries. I think that could be a mistake, because I do think what we're getting in treasuries, the nearly 5.5% now, won't last long term. I think in less than a year from now, we're probably going to be getting 2.5 to 3.5% in treasuries, which won't even be covering inflation. So I just think you need to be careful. You probably don't want to be moving tons and tons of your assets into treasuries. I'm not sure that's necessarily a good idea. I also wanted to share that there's a lot of concern with the banks still, and a lot of that concern comes about because of commercial real estate. And a lot of the banks that hold a lot of commercial real estate may take a hit too, because commercial real estate is really having issues currently because of these high interest rates and the fact that so many people didn't go back to their offices. So I think a lot of the commercial offices are actually like 50% full. So I think that may be the next shoe that drops, but I don't think, at least the banks I've been looking at, Truist and Schwab, I don't think they're a major part of their holding. I haven't dug deep enough into it for Truist, but I'm pretty confident with Schwab that that's not the case. So just something to be aware of and to keep in mind long term. I do think, like I said before, we're going to be still having a lot of volatility. It's still going to be good times for selling options. And I think you'll do better selling options than if you weren't. So that being said, let's turn to the next part of this video, where I want to share with you how I keep my selling of options safe. Now, I've had a lot of new members recently, and a lot of it depends on your personality. I've noticed a lot of very outgoing people, or people who are real risk takers, will jump in with both feet. And with options, that's not really a good idea. If you're new to options, take your time, educate yourself, do the research you need to do, and start slow. It's really slow and steady is the way to win. And then make adjustments as you're going. But so many people recently, it seems like they're jumping in too quickly. And it's important to kind of put the forethought and identify your goals. My goals personally are to build my portfolio. So I'm looking not just to sell options to make money, but to sell options to build my portfolio, to increase the size of my portfolio, and then also to increase the dividends that are produced by my portfolio. Since I started this and really learned the right way to sell options, I've gone from, I think, 13 or 1400 in monthly dividends to now I'm over 2000, and I want to keep, or close to 2000. I want to keep increasing that. So again, it's not just to sell options to make money. And that's why I feel one of the core principles to stay safe is to pick really good companies. Now that can be difficult. I've picked a few that aren't so good, like Lumen, which I'm keeping. I still, may recover, but again, it wasn't one of my best trades. Lumen, I think it's dropped from $10 to $2.50 or something along those lines. And then Big Lots, and I even went into the stores. I like Big Lots, but they've really struggled. Their stock, I think, is down 60 or 70%. So no matter what you do, you're going to have a few losses. And it's important to understand that because you can't avoid all of them. But the goal isn't to 100% success, but have a few losses and a majority, or profitable gains that you've done fairly well with. And that's what's happened with me. I might have 3 or 4 losses, maybe the stocks were assigned to me at a very low price and now they've fallen in value, but overwhelmingly, a lot of the stocks I ended up picking up at lower prices by selling options. So it's really important, again, to really learn how to invest too. So you can really learn how to sell options, but really also learn how to invest, how to pick good companies. How do you pick one company compared to another? You can look at PE, you can look at debt that they currently have. You can also look at, do they pay dividends? Are they increasing dividends? Typically a company that's increasing dividends each and every year is a well-run company, or they would not be able to do that. Next, diversification is kind of an interesting topic. At first, I wanted to stay more diversified with selling options. Now I'm kind of learning that doesn't really work real well. So I'm primarily working with a certain group of stocks that I want to work with, or ETFs. To give you an example, SCHD is one of my favorites, and it's actually, I believe it's right around 69 now, and paying almost 3.8% in dividend. And it's a really good ETF to work with, and I own quite a bit of it, and I'd love to own more. And then I also like companies like Williams-Sonoma, who has no debt, and they seem to do really well. And also Buckle, BKE, which is another company. I don't own it yet, but I've been selling options on it, and I do want to own it. So 2 really good companies that don't have any debt and pay good dividends. So at first I thought more diversification, but now with selling options, I'm actually thinking less diversification, especially with what you're trying to sell options on or sell puts on. And then with risk management, picking the right strikes, the right deltas. I get a lot of questions with people, well, why are you going out so far? Why are you going out 2 to 3 months? Now with me, if you can potentially do well or even better if you're selling 30-day options. So, I may do a 90-day, but if you could sell three 30 days at a specific strike, you might do better than, what I'm doing, which is picking something maybe 90 days out. Now, keep in mind, though, if you're doing 30 days, you're typically using a higher strike price, and you're taking on more risk. In my mind, the shorter duration is more risky. So with me being able to go farther out, I can pick much lower strike prices. I can usually pick up more premium. Again, in comparison to a 30-day, you can pick up more with a 90-day, but maybe not if you did 3 30 days. To me, that minimizes the risk. So for a good company, like I did a trade today, and if I had done a 30-day, I would have had to pick that stock around 47. I went 90 days and I was able to pick it up around 42, or sell the put with a strike price of 42. So considerably lower, and actually that $42 is below its 52-week low, and it's like its 5-year low. So it's another way to minimize your risk. Other stuff you can do is, fluctuate your durations. If you're selling covered calls, you can do different expirations. I do own a fair amount of like Intel, and I have 2 or 3 covered calls that expire on different days. I also do that with Cisco. I think I've got one that's expiring in June and another one that's expiring in July. So that's another way, because you never know when the market's going to overreact. And also it's important to understand that if you're in the money, the deeper you are in the money, if that trade is going against you, you should look at managing that risk. And to me, managing is trying to decide, can I roll it? Can I close it and then open another position that will more than pay for what it costs for me to close it? So I'll look at that. I'll look at, potentially is it still worth my while? Do I, again, that's where if you want to own the stock, it works out well for you. Another example is I have Schwab. I had sold a vertical put credit spread on Schwab I think back 2 or 3 months ago at $70, and it's deep in the money. Schwab is, I believe, below 50, but I could also sell the put that I purchased. So even though it would be assigned to me at 70, I will bring in probably another $15 and actually pick it up more like 55. So that's another way to mitigate your risk. So if you can purchase the put and turn the cash secured put into a vertical put credit spread, and that's just simply having a cash secured put and then looking to see if you can buy the put. And the reason that reduces the risk, by buying that put, you're protected anywhere below that strike price. So let me give an example, because this does get a little confusing. So if I sell a $60 put and then I buy a $50 put, if the price of the stock goes below $50, I can put it to someone else for that $50. So I'm protected anywhere below 50. So I'm only required to have the margin of cash for the spread. So the difference between 60 and 50, which is $10. And again, for options, it's 100 shares. So that's $1,000 minus any premium I might have already brought in. And that potentially reduces your risk. Another way that it reduces your risk is to always have enough capital to cover whatever trade you're making. So even though I'm doing vertical put credit spreads, I typically have enough capital that if all the trades go against me, I can potentially handle that. I won't, I may get a margin call, but I can move funds around and deal with it. And I've never had a margin call. Schwab will send you warnings saying you need to look and make sure you have enough cash because some of your options have been assigned to you. But that's very different than a margin call. With a margin call, you've got to do it quickly. You've got to sell things and move funds around. That is if you have enough money in the account. And that's typically called covered. So with a covered call, when you're selling a call, it's called covered because you already own the stock. And for a put, it's a cash secured put because you have enough cash to cover that put option. So again, that's another way to mitigate your risk. Another one is to start out slow. I've seen people start off with 4, 5, 6, 10 contracts. Start off with one until you really know the terminology and you know what you're doing. Start slow, and then you can increase. And that's what I've done. If you go back and watch the videos from the beginning, I typically would do only one contract, and I typically didn't worry about how much premium I made. It's only been recently that I've been trying to get around $100 for each contract that I sell, and I'm trying to sell 2 contracts. So I'm trying to get close to $200 for every trade that I make, and I'm pretty close to that. I think I'm between 185 and 195. I'll have some that maybe, in the low 200s and some that maybe in the 150s and 160 for 2 contracts. So that's another way you can mitigate your risk. And it's important to understand you really never know what the market's going to do. So you can't assume that, your trade is completely safe. Again, the banking industry is another great example. For the longest time, Schwab was trading in the 70s and 80s. And then within a couple of days, it dropped 20, 30%. The same thing with all the other banks. No one saw that coming. Of course, now a lot of people are, after the fact, they're aware of it. But it's more important to, just understand the trade can go against you. And again, it goes back to what I said at the very beginning. If you really want to own the stock, then it's not a big issue. Like with Schwab, I'm not sweating about it because I really want to own the stock. I believe in 2 or 3 years, it'll be back in the 80s. So even though if I pick it up in the mid 50s, if it's in the 80s in a couple of years, I'm doing quite well. Plus, I could sell covered calls on it. So I'm not really sweating it, and I have plenty of cash when it does get assigned to me. It actually expires next Friday. So at that point, if I haven't done anything, which I don't plan to do anything, it'll be assigned to me. So, up to this point, I don't own any Schwab, so it'll be the first time I've owned Schwab. The next important point is monitor your trades. So I do a weekly planning worksheet. I'm going to share it at the very end of this video, where I color code my trades or my positions that are in the money. I also, 3 weeks before they're going to expire, I put them on this planning worksheet. You can do other things, like you can set alerts, so you're alerted if a stock hits a certain price. There's a number of things you can do to monitor your trades, but you definitely want to keep an eye on the ones that are in the money. I know with Schwab, you can also set it up where you can see if it's OTM, out of the money, or in the money, ITM, on my actual page where I'm looking at my positions. So that helps a lot too, because just eyeballing it, I can see which ones I need to worry about. And that's really made a big difference for me. And in the past, when I first started selling options and selling covered calls, the only times they were ever assigned, I wasn't paying attention. I was just selling covered calls and thinking they would expire. And that wasn't the right way to do it. Monitoring has kept me a lot safer. It doesn't mean nothing's gone against me. Back in October, I had several positions get assigned to me, but that just comes with the territory. In a lot of cases, I would have rather had more get assigned to me. I missed some great opportunities. So, and I'll share at the end of the video, I'll share my planning worksheet for this week and my actual trades. Before I do jump into that, I do want to again mention, please subscribe, hit that like button. If you want to learn about my memberships, details are below. I have 2 different levels, and I share my trades, I share my spreadsheets. I also add special content, and again, I share my planning worksheets that people are free to use however they want to. And I have a more expensive membership too, where I provide one-on-one coaching once a week for 15 minutes. It's always over 15 minutes. It usually can be as long as 45 minutes to an hour. Again, I'm a small channel. I'm not real busy right now. Well, I mean, I am busy. I don't have tons of people subscribed. At some point when I have a lot more people subscribed, it may become overwhelming. But currently I do 4 or 5 of these coaching calls each week, and I really enjoy meeting the people and helping them. And they get access to Discord where they can also ask questions. I have people who share their trades and ask, what do I think? Is this something I should do? So if you're curious about any of that, take a look down below. The details will be there. And with that being said, let's jump into the next part of the video. Okay, here's my planning worksheet for this week. This is what I released to my membership last Sunday. And at the time, it shared any of the positions I had currently expiring, which is at the bottom of the spreadsheet. I also, at the top, I provide 4 stock picks. I provide, what type they are, what the current price is, what the short strike is. And these are what I'm looking at currently. These are positions I'm going to keep track of during the week and potentially make trades. I'm not actually guaranteeing that I'm going to make these trades, but these are ones that I found over the weekend that are really, really interesting to me that I potentially want to make. So my first, again, is Truist. It's, in my mind, way underpriced. Its current price is $28.69. I believe it came down. I believe it may be as low as $27 now. But I looked at a short strike of $22.50. Now, I understand that Truist was trading, I believe, pretty close to the mid-40s or over 50, and it's at 27. It's lower than it's ever been. I mean, I think in a little bit of 2020 with the COVID market correction, it may have gotten a little bit lower, maybe into the low 20s, but I believe it's been oversold. I could be very wrong. Maybe they have a ton of commercial property and they're going to take a huge hit, but I don't think so. So it's something I've looked at. I've actually have several puts that I've sold on it that right now are still out of the money. I think I did them at 25, but again, it's worked out pretty well. I add the delta. This is a 17 delta. Again, for most of my puts that I'm doing currently in this bear market, or around a 15 delta. And when I say a 15 delta, it's really hard to get an exact 15 delta. So this is a 17 delta. So typically it's below a 20 delta. And here I was, per contract, I could potentially get 100. And I also give a reason why I like the stock, DFS, which is Discovery. It's also been hit hard and is a good price value. I was suggesting a vertical put credit spread with it. Current price is 96. I was looking at 85.75 for the two strikes. Expiration for this and TFC was 616. This was a 17 delta, and it would bring in approximately $85. But again, this can change a lot. So these are suggestions. These aren't necessarily trades I'm going to make. Aflac is another one. I really like Aflac. I don't own it currently, but I've been selling puts on it. I do want to own it. Good company, and it's really at a good price. I believe it's come down a little bit more this week, but I believe it's like 66 something. But I was looking at 62.50 and 55. So again, another vertical put credit spread, not quite as wide a spread, expiring on 616, about a 19 delta, and it would bring in around 65. Now I found for Aflac, Discovery, and then the next one is MetLife, they all have expensive puts to purchase. So I've had a tougher time finding puts that are inexpensive. All good companies, all with good, strong financials. They may have slightly missed some of their earnings recently, but they pay good dividends and they've increased dividends. Next is MetLife. I believe it may be as low as 51 now. And here I was suggesting 47. You'll notice I did do a trade for MetLife, and I actually did it today, and we'll talk about that at the bottom. So here, 47.50, 37.50 are the two strikes. Expiration a little farther out, and I actually went farther out than July. So again, I like to go farther out to get a lower stock price, again, for safety reasons, to keep, if I pick it up at that price, I know I'm getting a really good company at a really good price. This was a 19 delta, so again, a little bit higher than I typically like to do, pretty close to a 20 delta, and it would bring in around 85. Again, the pricing of the purchases, or to purchase the puts, has been a lot higher than I expected. I think a lot of people are buying puts currently to protect themselves, especially if they own a lot of MetLife. It's pretty typical for an executive that may own thousands of shares of a specific company to buy a lot of puts to protect them on the downside. So, and this I put out each week. I try to make it different companies. They do repeat every couple of weeks, again, because I want to be less diversified, not over diversified. I'd rather be dealing with good companies, with good financials that pay dividends and then that are healthy debt-wise. So that's this top area that I do for my planning worksheet. And then here you can see these are the Schwab positions that are currently pretty deep, very deep in the money. This first one, which I did back in March, it expires at next Friday, and it's got a 70-60 strike. So it's way deep in the money. Again, it's almost $20 for the short strike, and the outer strike is over $15, I believe. I believe they're 47 currently, so it's like $13 deep in the money. So again, it would be assigned to me at 70, and with it being $47, I can almost assuredly sell this outer strike for $13, and I just have to do it before the expiration of next Friday. So something to keep an eye on, because there's not much I can do with the 70, but I definitely need to sell this 60 to bring in the $12 or $13 per share, which again, instead of owning it at 70, I would own it like at $13 less than that, which would be around $57. And again, the expiration is 5/19. So, and then I have another one that I did later. I thought it couldn't go down, and I'll go down more, and it did. So I did another one at 55. This one I may try to roll. I've been trying to roll it, and I found where I could roll it for a little bit of profit. I'm hoping as I get closer to the expiration, I can roll it, for a little bit more, maybe bring in $100 for these two contracts and roll it out a little bit, and maybe lower the short 55.45. So this one is in the money, and this is out of the money, but it's only out of the money by $1 or $2. But that could change rapidly. I believe Schwab got up to 53, 54 I think it was last week. So this one I'll probably roll, but again, it's actually in a retirement account, and I'd be okay with owning it because again, I would be picking it up and I could sell this put. So I'd probably be picking it up at 52 or 53 when you factor in the fact that I can sell the put that I purchased. So these are the ones that are colored yellow. It makes it easy for me to see, and I don't forget about them. And they're the only ones currently that are deep in the money that are expiring next week. I do have some others that are in the money. I don't think I have any others currently that are deep in the money, but they're my primary concern currently, and that's the whole idea with this planning worksheet. Next, I have IWM. This is the Russell 2000, and I did a roll, and it's a vertical put credit spread, 170, 160. It was expiring next Friday, and currently 174. I believe it's around 173 now, so it went down slightly, but I rolled it out to 721, and I lowered the short strike and the outer strike, so both by $2. And I brought in another $164 in premium. The margin that's required, or the cash that's required, is $18.35, and that's just the $2,000 due to the spread, $1,000 for each contract. 10 times 100 times 2 minus the 164.80, and that's how I came up with the 1835.20. And then if you base this on how many days that are left in the year, which is 74, it's like a 44% return. So in this Russell 2000 IWM, a lot of people will trade in SPY. I like to trade in IWM because it's a little bit easier price-wise. Instead of a nearly $400 stock, you're dealing with 170, and it doesn't potentially long-term do as well as SPY, but it's pretty close. It does fairly well long-term. And again, it's the Russell 2000, so it's full of 2,000 companies. So, and I have quite a few positions on it, and it's probably the only one that don't really want to own or don't really plan to own. I'm okay if I do end up getting it gets assigned to me, but I would definitely close this if it went against me. So currently, I'm still $4 or $5 outside the money. And I'm able to roll these fairly easy. And I think this is 168 is my highest strike. I think all the others are around 163 or maybe even lower. Next is Truist. So this is two positions that I do own. I rolled it, vertical put credit spread at 25.15, and it was expiring 6/16. So here's an example. I've had people ask me, again, why I'm going so far out. So when I did this trade, I kind of knew I would close it, and this trade got very profitable. I believe it was over 70% profitable. So I closed it literally, I think I closed this on Tuesday, over a month early. So in the spreadsheet I did a while back, this is probably a lot more profitable than it was in that original calculation. Current price is 28. Again, I believe it came down to maybe around 26 or 27. So I rolled it out a little farther, 9, 15, 23. Again, maybe I do think that Truist will be in the low 30s before long, and I can potentially close this for a profit or roll it again for an even better profit. If Truist goes up to 32, this position will become very profitable quickly. Now, it could do the reverse. It could go into the low 20s, but I believe I could roll it then at that point. So to me, this, trading in Truist is kind of a no-brainer at this stage. And I brought in $156.80. This is what was required. Again, 2,000 minus 156.80. And since I did go farther out, it's only like a 24% return. But that's kind of a funny thing to say, a 24 yearly return. That's still a huge return. And I believe this is the second or third time I've rolled it. So I would really be surprised if I can't roll it again or close it early, especially again if Truist gets into the low 30s. CWH, this is something I've owned a long time. This is Camping World. I rolled it. This is a cash secured put, at 22, and I've had it between 20 and 24, and I've done quite well with it. I think in that time period, I've made like $1,400 on it, trading it a little over a year. But it was expiring 6/16. So again, another situation where I closed it early and rolled it early. Again, rolling is just closing your current position and opening a new one. And a lot of times you can do quite well with that. A lot of times, though, what I'm trying to do now is just close it and then open it when it's even more like the market has gone down more, so I can do even better. But again, with limited time, and I do this very passively. A lot of times I don't have the time to do that, to really watch it, or I realize, oh, that happened yesterday, and today the market's way up, and it's way up, and I believe their earnings surprised, and they were trading in the money like 21, or I think they got to as low as 20, but as soon as those earnings came out early, I think it was earlier this week, they went up above $25 in one day. So they went up like 10, 15%. And I've seen a lot of that. I've seen if your earnings are bad, you get hit really hard. And for some companies, not all companies, if you have good earnings, the stock price will go way up. Here again, I rolled it out to 9.15. I kept the same strike price, but I brought in $231. And here, since it's a cash secured put, the cost or the amount required margin or cash wise is higher. And so it's 41.68, which is just the 22 times 2 and then 100 to come up with 4,400 minus this 231.40. And then since it's farther out and it's September, the return is lower. I think that's 128 days till expiration. But again, 15.9%, which isn't as good as some of the ones I've shown in other videos, but still quite good. And again, if I can close it a month early or 2 months early, then I can potentially roll it again, meaning if the stock goes way up, I should be able to roll it again. Now, this is the one I did this morning, MetLife, and it's another vertical put credit spread, 42.50, 32.50. So I actually went a lot lower. I went to 42.50 versus 47.50. And I don't know if that was necessary. I could have probably gone to 45 and brought in a lot more cash. But I don't know. Sometimes with the market being down, I think at the time it was down quite a bit this morning. I just decided to take a little less risk, bring in a little less cash, and that's why it's 42.50 versus 45. If 42.50 for MetLife is outrageously low, it's almost obnoxious like Truist. Truist at $24, $25 is almost obnoxious. I believe MetLife at 42.50 is almost obnoxious. I mean, you're talking about a stock that is a healthy, good stock, pays a good dividend. I believe they pay over, if I picked it up at 42.50, it would be almost a 5% dividend. So there's a lot of companies that have been beaten down lately that still have good earnings, and well-run companies that are paying above 4% in dividends, some as much as 5%. Like I think 3M is potentially paying over 5%. Now they've had some bad earnings lately, but it's another company. They definitely are more expensive, but I haven't owned MetLife yet, and this is the first trade I've done with MetLife. So again, 9.15, I did a little farther out, and it's currently at 51.31, so it's pretty far outside the money. I brought in 159.40, so a little less than I typically. Again, I'm trying to shoot for closer to 200, but in this instance, I chose a little bit more. It's more like 80 per contract. So with two, it's pretty close to 160. Here's the capital that's required, 1840 again, 2,000 minus the 159.40. And then this is like just shy of a 25% yearly return. So again, if I could get that kind of a return anywhere else, you can imagine what it would do to your account. So let me show you where I stand for this month. So for this week, I brought in 712. I had a really good week last week. I think I brought in over 1,200. So the total, I'm at 1938. So again, my goal is, here you can see it, is 1,000 a week or 4,000 monthly. So if I do one more trade of $100 or $85, $82, I'll be at my 1,000 weekly goal. Most likely, if I do a trade tomorrow, it'll again be between 150 and 200. So I will not meet the weekly goal, but I'd be sitting well for the monthly goal of 4,000. And again, this is just for selling options. And this week it was mostly vertical put credit spreads, actually vertical put credit spreads and cash secured puts. I've had a pretty even balance over the last 3 or 4 weeks between covered calls and puts. So, and that also works out really well, because if you're selling quite a few covered calls as well as the puts, as the market goes up, then the puts become more profitable. And as the market goes down, the covered calls become very profitable. So that's one thing I need to do. Again, I have limited time, but I need to go through and look at all the covered calls and see who's very profitable. I noticed just before the video, there were 2 or 3 that were in the high 80s that I probably needed to look at probably closing, especially if I can do it real inexpensive. If it's $30, $40 to close it, I typically will wait. If I can close it for less than I can, go out to lunch for, then I typically do. So this is it. This is my planning worksheet. This is what I share with my memberships and how I keep track of my shares, and what's coming up to be, where I have to manage right away or really keep track of, the positions that are higher risk. Now, sometimes I'll go a little bit farther out than 3 weeks if there's specific trades. Like I started adding Schwab back. I think this may be the 3rd sheet it's been on. So I added those 4 or 5 weeks ago because of the banking crisis. So, and this has made a big difference for me, and it's kept me keeping track of the ones that are really at risk. And rarely has something been assigned to me that hasn't been on one of these sheets, and I've been aware that it's going to be assigned to me, versus in the past where sometimes I was just surprised by an assignment. Back in October, when the market was at its low, there were a lot of early assignments, and I did talk to Schwab, and what they shared with me about that was there were a lot of margin calls back in October of last year, and people had to put stocks to people so they could pick up the cash. And that's what happened, because I definitely had some that were pretty far outside of expiration that got assigned to me, but that's very unusual. I would say most positions, you're safe, definitely safe if you're out of the money. If you're in the money, you're safe until expiration, and you really need to manage it for expiration. So that's it. I hope you enjoyed this. Hopefully the audio was better. Sorry about that, guys. I realized I had not adjusted things correctly. So hope you're having a wonderful day, and thanks for joining me.